are in listen-only mode.
Good afternoon and welcome to today's Premier Account short form market update. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation or offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hein, current Managing Director of Global Equity Management. Format for today's presentation, quick summary of the macro outlook. We review the stocks that we've been active in over the course of the last week, and we tie that in with the financial year 14's earnings per share outlook for those names and PE valuations, and we conclude with a summary of our portfolio allocations and short-term market outlook. The services that we provide are up on the screen there. If you'd like to know more about those, please contact either myself or Christine, info@investorsignals.com. Up on screen there's a graph of the XJO, and the real issues buffering equity markets at the moment are obviously the concerns out of the US around the first government shutdown that we've had in 18 years. In saying that, the probability of that having any lasting negative impact on equity markets, given that we've seen this before, is I think a little bit muted, but it's certainly going to be a difficult environment for equities to perform over the course of the next 4 weeks. No sooner will we get through this issue around the budget negotiations that we then face the issues around the debt ceiling negotiations that will soon follow in mid-October. So I'd expect to see the market sort of fit within our sort of base scenario, which is that, yes, they'll remain at elevated levels, largely supported by central bank policy and low bond yields, driving money into equities. They're probably likely to bump sideways at or near this current valuation from the XJO's perspective at around 15 times forward earnings, just over a 4% dividend yield. We think there's still some value, but the real story is, can central bank policy continue to pick up global GDP over the next 12 to 24 months? We think it probably can. Therefore, we're positioning equity portfolios on the basis that we get a period of consolidation, but in the new year we start to get some level of outperformance. The employment data for the Eurozone came in August. It was a marginal improvement. Eurozone manufacturing looked a little bit stronger. It expanded for the third straight month. And believe it or not, the US ISM manufacturing index also exceeded expectations. So we're continuing, whilst probably every reason to be a little bit cautious on the US right at the moment, the actual the manufacturing sector there's continuing to expand, and that's the strongest reading that we've had in over 2 years there. So at a macro level, we're still comfortable that equities provide a good investment opportunity, and to look at the specific assets that we're drawn towards, we continue to like Amcor, so we've been recent buyers of it in the last few days off this 10.50 level. We're working to sell calls up at around the 11.25 level going out into roughly around January. We're trying to get around 20 cents or so for those. That'll double the income flow. So instead of getting sort of somewhere around 4.5% dividend yield out of Amcor, when you combine that call premium, we'll be boosting that annual cash flow to in excess of 10%. I think the stock arguably is getting expensive here. I spent a lot of time chatting about this in prior recordings at about 16 times forward earnings and about a 4.3% dividend yield. The upside's probably fairly limited, not much beyond sort of that 11.25 to 11.50 area. However, given that the spin-off of the Australasian packaging distribution will help to unlock some value for shareholders in the months ahead, we're pretty comfortable that even in a softening equity market, the downside risks are pretty limited here for Amcor, so we continue to be drawn towards this name. Also ANZ within the banking space, obviously got ANZ, Westpac and NAB coming up to paying their dividends in November, December. ANZ trading at around 14 times earnings, or I should say 13 times next year's earnings, and on about a 5.3% dividend yield. We're drawn towards ANZ, selling the European-style calls out into December or January, also boosting that cash flow instead of 5% yield, boosting that up to around 10% and allowing for some capital growth there in ANZ. ASX also on this pullback. We're seeing value here at the moment in ASX as it sells off a little. We think fair value is probably closer back up to around 35.50, with the stock trading at about 17 times forward earnings and about a 5.5% dividend yield at these levels. There's not a lot of growth from an earnings standpoint here in ASX, but we think it's a fairly defensive story. Owning it at these levels, selling calls up at around 36.50, collects us that 10% cash flow per annum, and also locking in the opportunity for some capital growth if we're knocked out on the top side of that call at around that $36 level. Brambles, we've continued to be active in Brambles this week, so we have been owners of it at lower levels. This is one of those US dollar plays that we like. Our target here for Brambles is really up at around 6.50. We start to see it fairly full value, and the story there for Brambles is that on 16 times next year earnings and a 3.8% dividend yield, the stock's expensive. The company has highlighted that they're only likely to grow earnings at about 5%. If the Aussie dollar comes off a little bit further, we'll continue to see a sort of positive support there from an earnings perspective with the lower Aussie dollar. Another name where we've got a spin-off coming up with the recall assets before December, helping to unlock some value. But up at these levels, we think it's getting a little bit expensive. But again, we've capped it out predominantly around this 9.50 level. And I think that sort of captures the upside story there for Brambles. Coca-Cola, we've been buyers of Coca-Cola off this 12.20 support level. From a valuation standpoint, the stock trades about 16 times next year earnings, just over a 5% dividend yield. It's value down here. We're owning it here and looking to sell calls up at around the $13 level. CBA, we delivered during option expiry. We achieved $1.50 for the 72.50s, which gave us an effective exit price of $74. We'd be happy to take a look at buying back in the CBA if over the next month we see the stock pull back to sort of sub $70. Computershare, further with this sort of US dollar theme, we've been buyers of it around 9.75, selling calls up at around 10.50, getting approximately 20 cents for those, so giving us an effective exit of around 10.75. From a valuation standpoint, the stock trades about 16 times forward earnings and about a 3% dividend yield. We continue to be drawn to Computershare on that basis. Fox is a name. So this is obviously the faster growing assets within the old News Corp business. The old print and publishing assets have been spun off in a separate entity. So the earnings here for Fox are likely to grow close to 10% per annum. The real story, the company buying back $4 billion worth of shares. So whenever we see a slight dip in the price, the company gets a little more aggressive with their share buyback. So we own it at lower levels. We're largely capped out at around this $37 level, and I think that sort of captures the short-term recovery there for Fox. We've been accumulating GPT just in the last few days at around this 350 level. I don't expect it to shoot the lights out from where it is at the moment. We are coming down to a support level here in GPT where the stock's getting close to yielding about 5.5–6% on a forward basis, trading about 14 times earnings. They should grow earnings maybe somewhere in the order of 7%, I think, over the next 12 months. But around this $3.50, the stock should find support and trade back up to around $3.80, $3.90. And also within the property play, we've been active in Stocklands. So in the case of Stocklands, we own it at lower levels. We have delivered Stockland under the option expiry last month at around this 370, giving us an effective exit of about 380, 390 when allowing for the call premium. I still like Stockland, so we're happy to continue to be owners of Stockland at or near these levels. At about $4, $4.10, I think that captures the upside for Stockland. So on any push slightly higher, if we can get calls away at around this 420 level into the early part of the new year and collect the upcoming dividend, I think that's sort of a reasonable play there on Stocklands, again delivering in excess of 10% cash flow and allowing for some capital growth there as well. And finally, Transurban. Excuse me. Transurban, we own this name. It's coming into paying its dividend in December. I'd mentioned that we were buyers of it at lower levels here, looking for a rally into the year end. That's starting to occur at around $7. That's the opportunity to sell calls up at around $7.25. I can't see Transurban supporting a valuation anything above sort of $7.25 when you consider that the stock's already trading on just below a 5% dividend yield on next year's earnings. But I think given the defensive nature of its earnings stream and its dividend payout, I'd expect this to continue to move up towards that $7 price level again, looking to sell calls at $7.25. Telstra, we continue to be drawn towards Telstra just as a defensive allocation in portfolios. I think we're in this range where the stock's likely to consolidate at or near this $5 band. The stock's yielding about 6%, trading almost 16 times earnings. So our strategy here is try to sell the sort of 5.25 calls into the early part of the new year and boost that dividend income from sort of 5% per annum up to closer to 10% and allowing for some capital growth there. Also, Wesfarmers, we've been buying Wesfarmers this week, so as it pulled back to sort of below sort of $41, we started accumulating it yesterday. I think at around sort of $42.50 to $43, the stock starts to look a little expensive, trading about 19 times forward earnings and about a 4.75% dividend. So again, another name there through the covered call strategy, boosting that cash flow from sort of 4.75% up to 10% as a result of the dividends and the call premium, and then also allowing for some capital growth over the next 3 months if we are to get knocked out on that call strike of around $42.50. Woodside Petroleum on its pullback this week provided a little bit of a buying opportunity, so we've stepped in and started accumulating that yesterday. Our valuation here on Woodside is it trades about a 6% dividend yield, about 12 times forward earnings. Company should grow earnings by about 7%. I think sort of the story here is around $37 is pretty strong support level. At around $40 to $41, the stock starts to look a little expensive again for us. And then finally, this week we've been active in Woolworths again on this slight pullback that it's had over the last few days. We're buyers here and selling calls up at around this sort of $37 level into the early part of the new year, and collecting around 50-60 cents for that. So again, an example there where we're increasing that dividend yield from around 4% up to about 10% through the covered call strategy. Thank you for listening in to today's recording. It is only a short form webinar, and in next week's recording we'll do a full run through of the top 50 stocks and review their earnings outlook and PE valuations.